Just a show of hands, how many of you are looking at investing in Singapore next 12 months? Show of hands. Okay, still live in the Singapore market. How many of you are looking into Malaysia? About 10%? 10%? How many are looking beyond Malaysia, Singapore into Australia? Australia? Okay, maybe about 5%. UK? UK market? Maybe slightly less than 5%. How about other parts into Thailand? Hong Kong? Hong Kong? Manila? Into Philippines? No? No hands. Maybe I can't see so far. US? None. US? Excellent. Okay. This is the survey done by, I think, Straits Times. I just clarified, Winston. This is done by Straits Times. And this was done, I think, on February, I can't remember the date, but sometime in February. And they stipulated that about 70-odd%. This is the actual survey result. 79% of respondents, about 1,600 of them, actually said, yeah, they're going to invest in Singapore. 79% said, yes, they're going to invest in Singapore in the next 6 to 12 months. Malaysia, 34% said yes. And they did mention about Medini and Tropicana Danga Bay. Australia, 27% said yes, they're going to invest in the next 6 to 12 months. UK, they said yes. I think probably it's a close fight between Australia and UK. And then there were also other. They said that they are looking into Thailand. They're also looking into US and also diversifying beyond the traditional residential market. And they're going into commercial. Some are looking into hotel. Some are saying that they are going into investment purely on capital appreciation. So political stability, not so important. So what's happening in Thailand, never mind short term, they're going to capital appreciation in that sense. So interesting anecdotal information. Now this slide is from Morgan Stanley. I tend to get my slides from all over the shop. So it's just, in addition to a Chesterton House view, we also try to amalgamate a global snapshot of where the market is. For the global market, what this Morgan Stanley have mentioned is that keep a lookout on, I'm looking at opposite directions here, so keep a lookout from US right down to Indonesia. The first driver after the countries is your demand of growth. Now what you want to see, demand of growth, is for the arrow to point upwards. So that shows that there is huge demand, not only coming from abroad, but local demand supporting the local market. Then the next metrics, the next column is your supply growth. Supply growth, you want it to be as low as possible, stable, or it might come down. It shows an undersupply scenario. So when you have got a high demand and a relatively stable supply, that's where capital appreciation is likely to transpire. The third column, which is rents, you want rents to go up. Why? Because whatever you buy, you must be able to rent it out as fast as possible. And then the fourth component is your transaction volume. Transaction volume in a market, you want to see liquidity. Notice when you go into the market, it's easy for you to buy, it's also easy for you to sell. You don't want to go into a market which is relatively low liquidity, transaction volume very small or very low, so that if you want to sell, it'll take you months or years sometimes to liquidate your asset. So if you look at the analysis of a global momentum snapshot, so far on this, it looks pretty good for US. US has got high demand, growing supply, but at the same time, rents are moving up. And then you look at UK is still quite positive, demand is positive, supply is stable, which is good, rents is moving upwards, and transaction volume is up. And then you go into the other component of Singapore and Hong Kong, it's almost opposite. You've got Singapore, demand growth coming down, Hong Kong coming down, but on the other end, supply is moving upwards. So the lure of capital appreciation is going to be a bit more dicey in that sense. Rents is coming down in Hong Kong and Singapore. Well, Singapore is stable, according to Morgan Stanley, and transaction volume is coming down. So that's an interesting analysis from a house point of view. The rest of the columns, not important, because they're talking about investing in stocks, equities. So they talk about M&A and all your other IPOs and all that. So very quickly, Singapore, stable economy, very regulated market. So we are at the peak of the market. As a result, money is starting to look around, where else can I put my money? Which is why all of you are here, which is why I'm doing a topic on where are the investment hotspots around the world. So I'm trying to do investment hotspots, talking about all the markets in less than 30 minutes. Let's see whether I can do it. No one has done it before. So the number 2 location that most of the respondents said they're interested is actually Malaysia. Malaysia economy positive. In fact, the title I had here was Malaysia Potential Bubble Risk. Is there a bubble risk? I think there was until the government came out with their proposed budget measures, which was in October last year. We have seen spiraling in terms of prices, especially that of Iskandar. And I think because the government have intervened in the October budget, I think that let loose some of your hot air in the marketplace. The market is going through a period of consolidation, and on February, I think the 10th, the Johore's Land and Mining Office came out with a notification, with a paper saying that those in Johor who are looking to buying property, you can still buy, and you can still buy less than $1 million, $500,000 ringgit you can still buy, but provided the sale and purchase agreement is done on or before 30th of April. So there's still room for you to enter the marketplace. And that's a well-regarded clarity that the market was looking for. Now, if you look at Malaysia as a whole, now this is taken from Ho Chin Soon, which is a renowned research house, and you look at the pricing, it has actually gone up from over the last 22 years. It has actually started to spike from after the global financial crisis in 2010. If you look at prices, the red represents Wilayah Persekutuan, which is KL, Klang Valley prices. And you got Sabah performing very, very well. Penang, Selangor as a state, as an overall. Sarawak is doing very well. So you got a lot of rich people in eastern Malaysia. Plus, Johor is playing catching up in terms of price movement, but also performed fairly well if you're looking into the average movement in prices over the last 22 years. Johor, for compounded annual growth rate, we call it CAGR, actually grew by about 3.06%. So Johor is playing catching up compared to all the other markets. There are some who sense that Johor prices have actually gone up as high as KL. So you have to be location specific when you start looking into properties. But the overall things, if I look at the previous slide, it actually looked at the price, the actually timeline stops at 2012. What happened after 2012, which is in 2013? This one, I'm not sure whether you can see it, but this talks about your perubahan harga rumah suku tahunan, which is basically your quarter-on-quarter annualized, which means you compare, let's say, the first quarter of 2013, annualized, you compare to first quarter of 2012, on that basis. And the prices increase have actually started to come down from 2013 onwards. And because of the measures, it actually, this statistics only came out, this was from NAPIC, Malaysian statistics. It started to see a drop in the rate of increase. It's still moving up. The rate might be coming down, but that's your average growth rate on a quarterly annualized basis, but the rate has started to come down. I suspect when the government come out with fourth quarter and first quarter information, you'll start to see some price movement dipping downwards because of the measures. Mainly what the measures have done is it has actually took away some of the hot air, the speculative market. Now, what do you mean by bubble? When we talk about bubble, there are three components that attach to a bubble. One is when you see price appreciating beyond fundamentals, they say, if you're beyond economic rise or beyond your wage increases. So when, for instance, economy only grow 3-4%, but prices starts to grow 10-15% per annum, that's a bubble in the making. Second component is that when you see transaction volume starting to increase compared to previous historic, and transaction volume coupled with speculative activity. People buy today to sell tomorrow. That's another bubble. Third component is that you look at fundamental rental. Always keep an eye where rentals are heading, because when you buy a property, you must be able to rent it fast or easily. So look at where rentals are heading, whether or not there's going to be oversupply, and how you're going to get your returns from the property. Sometimes developers will start to buy, will give you rental guarantee. Some cases is genuine leases, like for instance, when you buy a hotel apartment, the hotelier is going to wrap up a lease back from you, and then he's going to rent it out as a hotel, and with the return, he's giving you certain returns. That gives you a sense of stability in terms of rental. So rental movement must keep up with capital values. You cannot have rental coming down or rental stable, and then your prices start to shoot up. That's a mismatch, and that creates a bubble as well. So if you look at the Malaysian scenario, very quickly again, this is from your NAPIC again, this is your statistics coming from like a URA in Johor. Interestingly, out of the total supply, Johor has about 40% of pipeline supply. Out of the total stock that it has, about 702,000, 40% of new supply, 40% of its total stock is coming out in terms of new supply in the next 3, maybe 6 years in that sense. That's a whole lot of supply, more than any of the other states in Malaysia. In fact, if you look at Malaysia's total supply, if you go down all the way down, if you look at total Malaysian supply is about close to 1.1, 1.2 million. Johor state alone has got 22% of the whole Malaysian supply. So that's a lot to chew. I'll come back later on where is our house view as to where the investment hotspots, where our own ranking in terms of fundamentals, in terms of capital appreciation, and where the lure will be in terms of yield and all that. Then we look at Australia, which is ranked 3rd in the ST survey. Economy positive. We're going through a slow period because of the mining boom is over, but its interest rates have started to come down to a lowest point right now. Home prices have exceeded its peak in after the global financial crisis, October 2010. Plus, we are looking at generally steady supply that's coming in. Certain markets are a little bit, there's going to see more supply. For instance, Melbourne, we're going to see more supply than compared to in Sydney as well. So you've seen a lot of launches among developers bringing Melbourne projects into this part of town. I'm not sure you can see it, but if you look at the left-hand side of the chart, you will find that Sydney prices are always higher than most of the other because it's a capital city price. Then you've got Melbourne, followed by Perth, and then you've got Brisbane prices. Most of the prices have actually peaked beyond your 2010 price movement. So the markets that are hotspots are typically markets where we've seen prices actually hitting its peak already. Just like in Singapore, like in Hong Kong, like most markets that we were experiencing have all hit previous peaks already. So the lure is to see what future supply there will be, where would be markets where it can be supported. Even though you've got a big supply, but can it be supported by rental fundamentals? Yields must be able to cover your rate of returns, your mortgage rates, plus it must be able to withstand shocks in the system. Certain countries have got different shocks. Some comes in geopolitical, some comes with election risk, some looks into potential cooling measures which don't know what the government is doing. The good news is that only Singapore, when they come out with government measures as a risk, it starts midnight today, right? When the measures come out today, they'll tell you it starts midnight. So there'll be a rush of Singaporean investors going to the show flat to ink the deal. But a lot of places in the world, when they talk about measures, they'll give you time to consider. Like in Malaysia, they'll tell you it'll be from, they announced in October, but it'll mention in January, it'll be effective. And now state government will come in and say, no, not January. It'll be from 1st May onwards. Even UK, when they come out with capital gains tax, same thing. They say, we are thinking of capital gains tax, but we'll give the market a little bit more information in May 2014. And then 2014, we will tell you, but it will be effective from 1st January 2015. So a lot of time for you to react, which is good, yeah? So look into that as potential risk. Singapore, you don't know what's going to happen, so that's also a potential risk, not in our favor. Now, UK is interesting. Again, question mark. Does the London housing market, is it showing a bubble risk? Well, it's interesting to note that UK, when we talk about, specifically, actually, we're talking about London. London, as a key global city, is a global financial hub. it has the world's global economy liquidity focusing on it. It's a magnet of investors. At any point in time, London will have investors coming from Russia, Eastern Europe, the Americans will be there. Then the last swing, we had the Singaporean and Hong Kongers. Now we have got suddenly a surge of Middle Eastern going in. And whenever there is a crisis happening in around the world, money will start to flow back into London. Why? Because it is a safe haven. It's like when there is a crisis in Asia, money will flow into Singapore as an important hub because people say, let's keep money here because it's stable. I don't want to lose money. Returns are low, never mind, but at least we know our wealth is being protected. That is the status of London. And London is elevated higher than Singapore. Singapore is an aspiring global city. London is already there. So if you look at currency-wise, London has softened about 30% in the last 3 years, 4 years against the Sing dollar. Of late, it has started to appreciate and recover about 10% already, just in the last 6 months. In fact, it has been one of the strongest performance, even currency-wise, compared to even US. This is the UK map. So when we talk about UK prices, actually the bulk of buyers are actually looking into London. London is a red spot. I can't point from here because it's a bit terbalik. But this is London, I think. And that prices have actually gone up by about 11%. Much more than all around the world, a lot around UK. If you look at the rest of UK, some parts above here, for instance, prices have not moved, In fact, when you go into the outskirts, the farmland and all that, prices have not actually moved. Chesterton, we are one of the strongest house consultancy in UK. We publish our monthly Chrome report, which I'll share with you if any of you wants to have an idea where the market is heading on a month-to-month basis. Keep an eye on rents. I'll give you our contact details, and we'll more than happy to provide you with some of our market research. Now, look at transactions again in London, in UK, or particularly London. Residential sale transactions are recovering, but still below peak levels. So if you look at your price movements or your transaction movements, here, this is London, the light pink. It is still below the peak of 2007, 2006. So that's good news because transaction is still not as high as historic. And then this is London residential prices, but London residential prices are now above the peak prices already. This look at the percentage it is from December 2013. December 13 values compared to the peak. The peak was just before the global financial crisis. So you look at, for instance, Kensington or Chelsea, the prices is already 147% higher than the peak in 2006, 2007. That's what he's trying to say. Yeah? And then we look at Wales and England and Wales, the rest of the markets, is still below the peak, about 92%. That means it's 8% below the peak of 27, 28. If you look at the supply and demand mismatch, right now, what the government is saying is that annual demand is about, what we need is about 49,000. What we plan to have is about 42,000 units every year. But what is actually completing, is actually this amount, which is only about 26,000, which is about a shortfall of about 16,000 units. That's interesting to know. Over there, they don't have BTOs like Singapore. 1 year, they can roll up 20, 25,000. Over there, it's a bit slower to get land, to reparcel it and all that. And some of the affordable housing will come from developers who are building high-end. They got, the low-cost housing is to be responsible of some of the private developers. So it's good to know in UK, while transaction volume is below the peak, prices might be above the peak right now, but in terms of what population estimate increases and all that, there is still a huge undersupply of about 16,000 per annum. This is but keep an eye, our Chesterton monthly report, we have started to see a slight dip in London residential prices, especially that there's a lot of 1-bedroom and 2-bedrooms coming up. Now this slight dip, for the 3rd consecutive month, we saw a dip in rentals, which means basically London city centers is getting a little bit too pricey. Rentals are getting a bit too pricey. People are now starting to move outskirts, which is why there's a lot of focus now bringing outskirts project like Royal Docks into the marketplace, you know, into Canary Wharf, where prices are all £1,000 per square foot and below. Thailand, I've got a lot of slides. I'm going to skip some of this, but Thailand generally, politically, it's a politically sensitive market. Generally, prices in the last 3-4 months have actually come down by about 10%. Volume have started to come off from it's a standstill market. Not many developers are bringing projects here because of the state of the market. But certain investors are looking into going into hospitality, going into Phuket, into Koh Samui and all that. To me, it's a medium long-term hold for the time being. US is interesting. And when I talk about US, I'm focusing purely on, as top investment destination, New York. You can invest in LA, Chicago, Washington, you can go into San Francisco. But I'm comparing the key market just as London. New York's probably the best place for one to invest because it is a financial hub. It's a global financial hub in that sense. Prices have actually generally gone up by about 14-15% per annum in New York. The price uptrend forecast for this year is about 5 to 10% this year. And because of QE easing, more money flow will come into US, and we're expecting the US dollar to actually strengthen among most currencies for this year. So to us, it's a short and medium hold, but there are certain issues investing in this. We will cover that later on in my later slides. This shows the general average price in New York. Again, price trend, it has already hit the previous peak. Indonesia, biggest problem is you're not able to get freehold title. You got hak milik and hak pakai. Hak pakai is your right to use. Hak milik is freehold title. So as foreigners, it's hard for you to get freehold title. So you got long leases, perpetual. But the Indonesian market is interesting because it's got a strong population base, strong domestic consumption, and that market has been very active. And that's what's been propelling some of the residential prices movement in the last 2-3 years. Office rentals has been one of the stellar performers in Asia-Pac. Same as some of the hospitality projects, retail, because of the sheer consumption, sheer population that's supporting the local market. For foreigners to get into the market, you need joint ventures, joint venture partner with locals. Then you can actually get about your hak pakai and freehold titles and all that. Currency have come down by about 25% last year. It's come up a little bit, but I think generally one of the lure is really your rupiah. Again, Manila, same scenario, one of the strongest GDP growth in Asia-Pac, very vibrant market, but to the investing dollars, to the investors abroad, a lot of foreign investors don't understand Philippines. It's just beginning to come up. Just be careful with Philippines when you go into the market. Different laws are applicable. Why? Because a project may get TOP, temporary occupation permit, but it can get temporary occupation permit for a specific project, and they can prevent you from using the larger part of that, like the swimming pool, or certain blocks might still be under construction. So just be careful what you're buying, because comparison-wise, legally, it might be a bit different from our understanding of a completed project when you buy. Yeah? And again, because it's a new market, it has got good freehold titles, it might be deemed near. Just make sure that you get good advice and compare it with some other investment destination when you compare. But generally positive market overall. Vietnam, again, I've covered this, sluggish economy. I think the market is just focused more on targeting on local Vietnamese inter-purchase. Foreigners can buy. Same thing, Myanmar, foreigners can buy, but unless they start to open up. In fact, some of the best values is in Myanmar. Some of the most expensive offices is in Myanmar. Rental-wise, it's as high as our Raffles Place or MBFC. Our hotel rates over there will be as high as some of the 5-star hotels that you're paying over here. Why? Because there's a lack of good quality accommodation, lack of good quality hotels, lack of good quality offices. So because of that, there's a lot of developers who are now starting to build and open up the market to foreigners. China has been undergoing restructuring. If you're looking at Chinese market, I think it's continue to be a playground for Chinese investors. For Singaporeans getting into that market, it's already crowded with the Chinese investors already. In fact, Chinese investors and developers are starting to come out of China, putting money out. I think there's probably a short window before prices might start to correct. But again, you never know. China's market is quite intertwined with the economy and government measures as well. Now, Japan looks interesting because of Abenomics, seems to be working. Third largest economy in the world. We're starting to see inflation steady at about 3% now. We're starting to see output positive. We're starting to see the economy coming out of recession. So it's the beginning stage of a economic expansion after 10, 12 years in doldrums already. So there is a positive scenario where companies are now starting to invest, local companies. Investors are starting to come in again. And we're quite positive about the Japanese property market. Yen has devalued by about 27% against Sing dollars since 2012. And because Japanese themselves are coming out with trillions of yen as part of their QE, we expect more consumption and the local Japanese buying property, and that would see elevation in terms of prices. We expect, however, yen to soften by about 5% by the end of this year. At least that's the house view of Bank of Tokyo, Mitsubishi, UFG. And I think that's probably something that you might want to consider. You buy something, there is a potential that the currency might drop in the short term. Brazil, I won't go through too much. I don't think anyone put up your hand for Brazil, but it's one of the strongest property market in the last 3 years. It has gone up more than Singapore or Hong Kong, again from a low base. But it's a market that not many people understand. It's also far away for you to monitor. Not like Malaysia, you can just take a drive. But it's in a bubble territory right now, so be careful if you're buying any properties abroad, especially that relating to Brazil. It has gone up because mainly of the lure for the World Cup. Just like Japan, it's got the Olympics in 2020. There could be a lure moving upwards. Same thing as Brazil. It's a playground for a lot of the Americans, the South American dollars. UAE, we've got an office over here. Market came down 60% after the global financial crisis. It came up 40% up to now. Now speculative activity is at a feverish stage right now already. I've seen some developers bringing projects over here. But again, it's a market that moves in spikes. So unless you're there to monitor the spikes in short period, you might want to avoid for the time being. This is the Economist House Price Index. And if you look at the blue, the top line, that's Singapore's prices. It has gone well beyond the peak prices. And then you've got the one in, I think, brown. The second line from the right would be Australia prices. Again, peakish. Then you've got Britain prices, which is also almost hitting the peak already. And then you've got the line which is orange, Japan. Japan has come down, and we think in this year prices will start to pick up already because of Abenomics. And the last line is actually your US, where prices generally have gone up. But these are all centric towards countrywide. If you look at specific cities like London, Tokyo, New York, it might outperform this line. In fact, the lines might show a higher appreciation. Now, this is Chesterton's top international picks. This is based on capital appreciation, high liquidity market. We want to invest in a market where we can come in and get out as fast as possible. High yields, i.e. yields must be higher than your borrowing costs. If not, you'll be on negative equity basis. And positive short to medium term outlook over the next 1 to 3 years. So if you look at these slides, our Chesterton top investment picks, actually it's London. Surprise, surprise, it's London. Why? Because the London market, the government is helping their locals to buy properties through the scheme called Help to Buy. So locals generally cannot afford to buy at today's London prices. So what they do is that anything which is less than £600 and below, Londoners can go and apply for deposit. Instead of paying 20% deposit, Londoners only pay 5% deposit. The remaining 15% you can get a bank to basically pay for you on your behalf, which means higher loan-to-value ratio, higher LTV. So that mass market segment will start to drive your market, your transaction volume. And more transaction means generally there's a tendency for prices to move upwards. But again, albeit more outside London in today's market. And this Help to Buy was introduced by the government last year. And they've gone one round, they're going second round next year. And there's a lot of potential for prices to move up in the shorter term. The concerns, of course, for London is that market's at a peak. When you buy, you uncharted waters lah. The other component is that the proposed government capital gains tax could have an influence of foreign money coming in, because that is supposed to be taxed on foreigners, non-UK residents. And that, so far the announcement have been positive. We're seeing more continued liquidity entering into the London market, despite government talking about capital gains tax. To a lot of foreigners, it's fair, because local have to pay capital gains tax. So far, non-residents don't have to pay. You're just equating it to the same. We've got, next is Tokyo. Tokyo is interesting because we think the market has bottomed. There's supply, not much in the marketplace, but focus on Tokyo as a main of focus area if you're looking into investing. You got a lure of Olympics. You also have low interest rates in the market as well. You can borrow Sing dollars. You can borrow from local bank. You can also borrow from Japanese bank as well. The only problem is, so your yields could be, your interest rate could be about 1% if you buy and borrow from Japanese banks. And your yield can be as high as about 3-4%. So your arbitrage is about 300 basis points, which is quite attractive compared to a lot of markets. Singapore, you borrow, first 3 years will be about 1.8, 2%. Your yield is about 2, maybe 2.5, 3%. Your arbitrage is much lower. The problem there is language, cultural difference, hard to enter unless you got people on the ground. And you must have when you buy a property, you need to have the property manager or the developer helping you to rent the premises, because language is a barrier and you've got to find tenants. So you need to have lease management experts to be able to lease properties for you. And also because of declining yen. So we think the best time to go in for Tokyo property is probably towards your second half this year. Again, we don't know whether the yen depreciation would have actually bottomed out by then. Second, the third interesting market is, of course, Malaysia, because close proximity. Affordability is one of the major factors of entering into the Malaysian market. RM has actually weakened to a new low, and we have seen generally it's a relative ease of entering the market. And that's a tremendous attraction. The concerns, of course, is your looming oversupply. Government measures, and also, unfortunately, some of the policies lack clarity. Take into consideration that whatever you buy in Malaysia, when there's policies that is introduced by the federal government, the state government can veto, say, no, we don't agree on federal government. We're going to have a different set of rules. Just as like Johor, for instance, when federal government comes out with rules effective this year, the Johor government said, no, we will give more time. 1st May, we'll start to implement all this. So that is the state of the matter. Yeah? So local, state government have got an overriding veto rights against the federal government. But clarity is an issue. I think a lot of, unlike Singapore, when they announce, they will tell you who can buy, who cannot buy, and that's it, very clear. Even up to today, a lot of developers in Malaysia, in Johor especially, they don't know whether, if I've gotten approval, can my project, prior to 1st of May, can my project be exempted against the 1 million investment ringgit to sell to locals? They're still in the dark. So a lot of clarity, policies need to be communicated, not only to developers, but investors. Then we'll start to see confidence coming back again. Oversupply is a major issue. Rental market needs to highlight. So there are certain areas where you can buy in an oversupply area, but target on scarcity. I spoke this in my last talk at my paper. Invest in scarcity in areas where the government is investing on infrastructure. So like your HSR stations, primarily, not only HSR stations, but primarily your RTS, or if you're going to Kuala Lumpur, invest in your MRT stations, vicinity of about 400 meters. For Johor, look at where your RTS, your rail transport system will be located. There's one coming up in the central area. Nobody knows where the location will be, but it will be quite close to the central that connects directly to the Singapore woodlands, likely to go underground, undersea. Again, when you are within your 400 meters away from your infrastructure, typically it is like a Singapore example, you see highest appreciation of value moving forward, and also easy to rent. Focus on the rentable factor as well. Then you've got number 4, you'll be your Sydney, Melbourne. I tend to focus more on Sydney and Melbourne because these are your 2 key global cities in Australia. And the rest of the cities are smaller, like Perth. Last year, Perth was one of the highest in terms of price appreciation. But again, Perth is a small town. I've asked a lot of my foreign institutions, why you don't buy office buildings in Perth? They say, I buy office building, 100 million, who do I sell to? I'll be the biggest landlord in Perth. Then who do I sell to? I'd rather be a smaller player, 100 million office buyer in Sydney or Melbourne, where there are a lot of institutions also looking to buy. And when I offload, it's easy to offload to other people. There are other big boys in the marketplace. So sometimes you want to be in a market which is more palatable, and in a market where there's more liquidity, so you can sell your assets. So focus on on key cities, Sydney and Melbourne. If you're going to Australia, the Australian dollars have weakened, but the yields are quite attractive. Yields generally about 4 to about 6%. Again, you can borrow from Sing dollars, take advantage of low interest rates if you need be, from Sing perspective of borrowing from local banks. Again, Australia is a smaller international buyers market comprising of mainly Southeast Asian, Chinese, Hong Kong, and New Zealand buyers. Not many in the marketplace. Overseas, European, US is a bit too far as destination. The 5th areas that we focus on will be New York, which is in US. Why? Because it's a global capital financial city of the world. It's almost the same status as London. Whenever there is a crisis around the world, money will go into New York, money will go into London. So it has got that sustaining power. So even a drop in price in the worst of times, 5–10%, money will start to come back again because people are always looking into ways to position themselves. So places like New York, London, prices never actually came down more than 10–15% before it started to come up again. The only problem about New York is that the market is peaking. And also they've got capital gains tax, perpetual. You buy, you sell, any point of time, you still have to pay tax. And various taxes at state level, at council, local level, at country level. Financing could be an issue. But get the advice, you enter into the US, contact your accountant, set up a special purpose vehicle, and that could help you to eradicate all your problems of taxes. In summary, quick one, just 2 minutes. No such thing as low risk, high risk. Low risk and high returns, no such thing. High returns always comes with high risk. Invest in key gateway cities with high liquidity and market. Go into areas where there's huge international audience. Asia is generally in a mode oversupply, so switch focus to other sectors if you need be. Retail, office, hotels, even logistic properties are deemed as very stable markets. Invest in scarcity. Invest in where government is spending on infrastructure. Like in UK, invest in the Crossrail area where the stations are going to be. Pay attention on rental and yields. Look beyond guarantees, because the guarantees sometimes might not give you a true picture whether you can rent after the guarantees are over. Focus on risk, availability of financing and all that. And then look at all the other risks, which is geopolitical, natural disasters, elections, cooling measures, and all that. These are some of our reports in Chesterton. If you need any of this or a slide of today's presentation, just take down our email address or just go to our Facebook, join, and just like us, let us know what markets you're interested. We'll be more than happy to provide you with information. With that, thank you very much for this. Thank you.